How to become a millionaire. Index fund investing for beginners. Hey everyone, welcome back to the channel. Today we're diving into how to become a millionaire through index fund investing, specifically for beginners. If you're new to investing or looking for a low-risk way to build wealth, index funds are one of the best options out there. They're even endorsed by billionaire Warren Buffett. Plus, they're a key tool for achieving financial independence, retire early. In this video, we'll walk you through how to invest in index funds step by step, so by the end, you'll have a clear plan for getting started. Let's jump right in. Step 1. Review your finances and goals. Before you begin investing in index funds, it's important to have a solid understanding of your finances and goals. Think about where you are in life, what you want to achieve, and how investing can help you get there. Start by asking yourself, when do you want to retire? How far are you from reaching that goal? What's your current budget, and how much risk are you comfortable with? Once you've figured these things out, you'll better understand the role index funds can play in your life and how much you should invest. You'll also want to take stock of how much money you can realistically put toward your investments. To do that, review your financial situation by answering these questions. What is your annual income after taxes or your take-home pay? What are your current expenses? How much debt do you have, and what are your monthly debt payments? What's your net worth? That's your assets minus your liabilities. Getting answers to these questions will give you a comprehensive view of your financial situation and help you figure out how much you can afford to invest. Plus, understanding your goals will help keep you motivated along the way. It's also crucial to assess your risk tolerance. When it comes to investing, risk and volatility are unavoidable, but you can invest within your comfort zone by determining how much risk you're willing to take. Your risk tolerance refers to the level of risk you can handle and how much money you're okay with potentially losing through your investments. Step 2. Choose an index. Next up, you'll need to choose an index. Index funds are a type of mutual fund or exchange-traded fund, ETF, designed to replicate the performance of a specific market index. Now keep in mind that ETFs can be part of index funds, but not all ETFs are index funds. There's a distinction. So why should you care about index funds? They offer two major benefits. 1. Diversification, because they spread your money across a wide variety of investments. 2. Low costs. Index funds tend to have lower fees than actively managed funds, making them a cost-effective option. Julian Schubach, Senior Vice President of Wealth Management at ODI Financial, explains that index funds track broad sectors like large-cap stocks, emerging markets, or major indexes like the S&P 500. There are also more specific options like funds that focus on large technology companies. Indexes come in many forms, but they all share one key feature: diversification. One of the most well-known indexes is the S&P 500, which tracks the top 500 publicly traded companies in the US. By investing in an index like this, you're getting exposure to a broad slice of the market. Step 3. Decide which index funds to invest in. Now that you've picked the type of index you want to track, it's time to choose specific index funds to invest in. Schubach offers a few tips for this. Each fund and fund company may have different fees and portfolio construction, so it's important to research the differences between each offering within a broad index. Start by researching assets under management, AUM. This tells you the size of the fund and can give you a sense of its stability. Fee structure. Pay close attention to both short-term and long-term fees, as these can impact your returns. Ease of trading. Some funds are easier to buy and sell than others, so make sure you're comfortable with how the fund operates. Management team. Check the background of the managers running the fund to ensure you're in good hands. Even though two index funds may seem similar, fees can vary significantly, so it's worth diving into the details. Look out for two key expenses. 1. Tax-cost ratio. This tells you how much tax you'll owe based on the fund's distributions relative to your returns. 2. Risk-expense ratio. This covers the fees associated with managing the fund. Even small fees can add up over time and reduce your wealth without you even realizing it. Look for funds with low expense ratios, ideally around 1% or less. Finally, check if the fund has a minimum investment requirement. For example, Vanguard's Total Stock Market Index Fund Admiral Shares VTSAX requires a minimum investment of $3,000. Step 4. Open a brokerage account and buy index fund shares. Once you've picked your index funds, the next step is to open a brokerage account and actually buy shares. But first, you need to decide, do you want to manage the process yourself, or do you want help from a professional? Schubach breaks it down. Investors need to decide if they want to pick the index funds themselves and manage the allocations personally. If so, they can open an investment account with platforms like Fidelity, TD Ameritrade, Charles Schwab, or even app-based platforms like Robinhood. If you choose to go the DIY route, research the available funds on your brokerage platform and buy the ones that align with your goals. If you'd rather have someone else handle the details, consider hiring a financial advisor or using a robo-advisor to manage your investments for you. Step 5. Continue to manage your investments. How to choose an index fund. Even though index funds are generally low maintenance, you'll still need to keep an eye on your investments and manage them over time. There are 2 things you should do regularly. 1. Stick to a consistent investment schedule. Whether you're adding money to your portfolio monthly or setting up automated contributions, staying consistent is key to building long-term wealth. 2. Check in on your investments periodically. Even though many index funds automatically rebalance, it's still a good idea to review your portfolio at least once a year or even quarterly to ensure everything still aligns with your goals. How to choose an index fund. Choosing the right index fund can seem overwhelming, but there are a few factors that can help guide your decision. 1. Business sector. Invest in a sector that aligns with your values or interests. For example, if you're passionate about clean energy, you might look for funds that focus on that. There are also index funds that focus on technology or companies led by women. 2. Risk tolerance. Take a look at the historical performance of the index you're considering and decide how comfortable you are with the potential risk. Index funds are generally considered lower risk because they're diversified, but some carry more risk than others. For example, large-cap indexes might have higher risk, while specialized bond indexes might be safer. 3. Growth potential. Are you interested in investing in fast-growing sectors or emerging markets? If so, look for funds that target those areas. 4. Geographic focus. Some index funds are focused on specific regions or international markets. If that interests you, there are plenty of options to explore. 5. Company size and market capitalization. Index funds can track companies based on their size, small, mid, or large cap stocks. This can affect the level of risk and growth potential. 6. Asset class. Finally, decide whether you want to invest in stocks, bonds, commodities, or a mix of assets. Different index funds track different types of assets, so make sure you're picking the one that aligns with your goals. And that's it. By following these steps, you'll be well on your way to getting started with index fund investing and building long-term wealth. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more content like this. Let me know in the comments if you have any questions or thoughts, and check out these other videos for more tips on personal finance and investing. Thanks for watching, and I'll see you in the next one.